There's been a slight level of pushback from Philip Lane at the ECB this week as he's talking about chopping up the rate path. It's very much against this current narrative of jumbo-sized or significant moves, the other language used by other ECB board members. So what happens from here around that terminal rate? What would your expectations be for Europe?
I mean, that's a very interesting question. And actually, I think you put the finger on the spot. In my opinion, I think that's the most critical question of them all. It's less important how quickly we get to that terminal rate, but where that terminal rate actually is. Most ECB speakers, even including such hawks as Holzmann from Austria, have indicated a neutral level at around 150. Now, the market is already pricing it quite a bit beyond that. And I even think that in an environment where inflation is going to stay potentially significantly above the target for quite some time, there is an argument to be made that the neutral rate where they want to get to is higher than the 150 that is generally being sort of advocated. So I can see that the market cannot really price 150, even though the ECB is indicating that. But the neutral level, that's, I think, where they initially want to get to. The question is, where is that? I would say it's probably a bit higher than where most people think.
Peter, if we talk about a neutral level at 150, that is much lower than the Fed, which perhaps magnifies why we've got that weakness in euro versus the greenback. What happens from here? Do you see any respite?
Well, first of all, if I may just say, I mean, in case of the US, of course, the neutral level is higher because the general sort of growth level is higher. But also what the Fed has said, in contrast to the ECB, that and Powell said that very clearly last week, that they want to go beyond neutral and want to stay there for quite some time. So I think that's clearly a different policy choice, at least what has been communicated compared to what the ECB wants to do. And in that environment, as you just rightly pointed out, it's a dollar strength story from an interest rate perspective, but it's also, if we see sort of what's happening with risky assets and the sliding nature of risky assets, be that credit or equity, that's typically positive for the dollar as well. There's a consensus generally that goes against that grain, but we as a house, we think there is probably still more dollar strength to come here.